What if I told you that the $50 billion expected to be wagered on the Men's World Cup kicking off today is actually just a massive loss leader? Or that a health insurance algorithm denying medical care to an elderly patient is exploiting the exact same psychological vulnerability as a budget airline charging you an extra fee to sit next to your toddler?
It sounds totally disconnected, but the underlying reality is that the modern global economy has, evolved past the point where the most reliable profits come from simply building a vastly superior product. Engineering the space around the consumer is just far more lucrative.
Because we spend so much of our mental energy bracing ourselves for the massive financial transactions in our
Yeah.
lives, right? Buying a house, negotiating a starting salary, rebalancing a retirement portfolio, we treat those moments like financial battlegrounds. But the mechanisms extracting the most consistent margin from you on a daily basis they're entirely invisible.
Exactly. Well, corporations have realized that capitalizing on everyday friction or leveraging massive regulatory blind spots provides a much higher return on investment. I mean, you do not need to build a better mousetrap if you can algorithmically predict exactly when the mouse is too exhausted to navigate the maze.
Today is June 11th, 2026, and our exploration of the source material today focuses on four distinct market pressures that illustrate this invisible extraction perfectly. We're examining the financial friction deliberately built into government-funded healthcare, the algorithmic pricing strategies dominating commercial aviation, the ultimate customer acquisition funnel operating at the world's biggest sporting event, and finally, the strategic thresholds triggering multi-billion-dollar corporate takeovers.
And the goal here is to really take a clear look under the hood of these everyday money mechanisms, stripping away the dry analyst jargon to reveal the actual human incentives at play.
So what does this all mean? Let us start by looking at a federal watchdog report that just scrutinized how Medicare Advantage plans handle requests for post-hospital recovery care. The numbers paint a pretty brutal picture of how manufactured bureaucratic friction generates massive revenue.
Yeah, the central finding from the investigators focused on an incredibly high rate of medical denials and the subsequent appeals process. A massive volume of initial denials for medically necessary care are being completely overturned, but only when patients or their exhausted families manage to, navigate the complex appeals process.
Which requires an enormous amount of administrative stamina. The report specifically highlighted a care management company called Navi Health. Now, this contractor is owned by United Health and is frequently utilized by various Medicare Advantage plans. The raw data showed this single contractor was denying roughly 54% of requests for inpatient rehabilitation facilities.
And an astounding 65% of requests for long-term care hospitals. Just to put that into perspective, rejecting over half of all patients coming directly out of severe hospital care is a staggering metric.
But the critical piece of data that reveals the true market mechanism is that reversal rate, isn't it? When a company denies 54% of all inpatient rehab requests, but a massive portion of those rejections are magically overturned the moment a family member formally files a complaint, it stops looking like an overly cautious medical review.
It starts looking like an intentional business model. We're looking at a system banking entirely on the friction of the appeals process.
It actually reminds me of the old mail-in rebate model from the electronics store days. Companies used to offer a $50 rebate on a new printer, knowing full well that a large percentage of consumers would simply lose the tiny receipt or miss the arbitrary 30-day deadline or just give up on the cumbersome paperwork altogether. The company kept the cash. But here, the stakes are not a cheap office printer. The stakes are an elderly patient's physical recovery. Wait, so the algorithm's default is just, no, it is literally programmed to assume the patient will just give up.
Because 3 or 4 massive insurance conglomerates control almost the entire Medicare Advantage market, you can't simply take your business elsewhere if you dislike their policies. They set the rules of the board. And when you consolidate that much market dominance and apply automated prior authorization algorithms to patient requests, the default setting financially favors rejection.
Because denying a claim, even temporarily, preserves capital on the insurer's balance sheet for a longer period, allowing them to earn interest.
Precisely. The algorithm essentially wagers that a predictable percentage of elderly patients will simply lack the administrative energy to fight the denial. The process of calling 1-800 numbers, waiting on hold, deciphering complex medical codes, that transforms bureaucratic fatigue into a direct line item of retained earnings for the insurance provider.
Let me introduce a skeptical perspective on the macroeconomics of that system, though. Medicare Advantage is ultimately funded by taxpayer dollars. If an automated system is technically limiting payouts reducing the immediate cost of post-hospital care and forcing cheaper alternatives, a fiscal conservative might argue this algorithm is actually acting as a ruthlessly efficient mechanism to save government funds in the short term. Where exactly does this cross the line from tough fiscal management into an actual market failure that damages the economy?
What's fascinating here is how short-term savings on a private insurer's balance sheet inevitably create massive long-term liabilities for the broader public healthcare system. When a patient is denied medically necessary rehabilitation, their physical recovery is delayed or permanently compromised.
Meaning that specific patient is statistically much more likely to experience a severe medical setback within weeks, like a fall at home, an unmonitored infection, or just a chronic physical decline that lands them right back in the emergency room.
And emergency and acute care interventions are exponentially more expensive than routine preventative rehabilitation. So the market failure occurs because the private insurance company captures the immediate financial benefit of the initial denial, while the broader healthcare system, and ultimately the taxpayer, absorbs the delayed, highly inflated cost of the resulting medical crisis.
So UnitedHealth relies on the exhaustion of fighting bureaucracy to pad its margins. But what happens when a company leverages an even more powerful human emotion? The panic of being separated from your child in a crowded, high-stress environment. We see a very similar psychological mechanism operating in consumer travel, specifically regarding how budget airlines monetize the physical space between a parent and a child.
Right. A major UK consumer watchdog just recently opened a formal investigation into Ryanair. They're examining a highly controversial policy that charges an £8 mandatory family seat fee each way for a parent to simply sit next to a child aged between 2 and 11.
The regulatory tension here sits squarely between strict statutory aviation safety rules and aggressive corporate revenue generation, doesn't it? Aviation regulations fundamentally require that young children be seated with, or at least very close to, their parents or guardians.
Because in the event of an emergency evacuation, a separated toddler presents a massive safety hazard to the entire cabin. The airline is legally bound to fulfill that basic safety obligation regardless of ticket class. The consumer law question being investigated is whether it constitutes an illegal or unfair business practice to charge a parent a mandatory financial fee to facilitate a seating arrangement that the airline is already legally mandated to provide.
Okay, let's unpack this, because Ryanair's defense is highly specific regarding how they structure the actual transaction on their website. The airline points out that adults traveling with children pay for one reserved anchor seat fee, which is the £8, but they can then select reserved seats beside them for up to 4 children on the same booking, entirely free of charge.
Their corporate argument is essentially that they are merely charging the adult for the premium privilege of selecting the specific row while honoring the safety mandate by seating the kids next to that chosen row for free.
Which forces the watchdog to evaluate whether this is a genuine violation of consumer protection laws, or is it just a highly efficient, thoroughly unbundled pricing model that consumers simply despise because it feels extortionate.
Regulators view this entirely through the behavioral economics lens of drip pricing. This is the slow bleed of the modern digital checkout process. A company advertises a highly attractive rock-bottom base fare to capture the consumer's attention and lock them into the sales funnel.
You click on a £20 flight to Spain, and then, as you proceed through the booking screens, unavoidable or practically mandatory fees are slowly revealed or dripped into the total cost. You pay for a carry-on bag, you pay to check in at the airport.
And by the time the parent realizes they must pay an extra mandatory fee just to ensure they sit next to their 4-year-old, they have already invested 20 minutes entering passport details, cross-referencing hotel dates, and, mentally committing to the family vacation.
It's the digital equivalent of a sunk cost fallacy. You have spent all this time organizing the logistics for a family of 4. You are not going to close the browser, abandon the itinerary, and start all over on a rival airline's website just to protest an £8 fee.
The behavioral economists working for the airline are banking their entire quarterly revenue projection on that exact human reluctance to start over. The psychological friction of abandoning the cart outweighs the financial sting of the fee.
Which is why the regulatory landscape is shifting aggressively. The UK watchdog now holds the statutory authority to fine companies up to 10% of their global turnover for egregious consumer law breaches. A 10% penalty on global revenue fundamentally alters the risk calculus for airlines that rely on drip pricing as a core pillar of their business model.
It changes the math completely. The revenue from the £8 fee suddenly looks a lot less attractive when weighed against a potential multi-million-pound fine.
Taking a quick beat to remind you that if you are enjoying this breakdown of the hidden mechanisms shaping the market, you can find Financial Candy, Brain Candy, and classic audiobooks at clarineratio.com. Now, we have been talking about capturing captive families on a commercial flight. Let us look at the ultimate mechanism for capturing a captive audience at a global scale. Today, June 11th, 2026, the Men's World Cup officially kicks off across the United States, Canada, and Mexico.
And market forecasts expect this to be the biggest single betting event in global history, generating over $50 billion in wagers.
The sheer scale of that capital flow requires some structural context, though. $50 billion represents a massive leap from the roughly $35 billion wagered during the 2022 tournament in Qatar. The drivers behind this surge are highly engineered by both sporting bodies and financial operators.
First, the tournament format was expanded from 32 teams to 48 teams, increasing the total number of matches from 64 to over 100. In the gambling industry, more broadcast inventory directly equals more betting opportunities.
Second, the time zones in North America provide prime-time evening viewing hours for lucrative, highly established betting markets in Europe and Latin America. And crucially, we have seen a massive state-by-state expansion in legalized sports gambling in the U.S., where roughly 65% of the population now has legal access to place a mobile bet from their living room.
If we connect this to the bigger picture, the underlying mathematics of the digital gambling industry rely entirely on behavioral addiction rather than casual entertainment. The World Cup isn't just about sports wagers. It's a massive customer acquisition funnel.
Because the underlying strategy is to convert casual, one-off sports bettors into high-margin, multi-sport, or casino game gamblers. Industry watchdogs note that the billion-dollar valuations of these betting companies are not built on occasional punters betting $20 on their national team.
Not at all. Data illustrates the reality brutally. 79% of corporate gambling winnings are extracted from just the top 10% of spenders. Furthermore, 99% of sports bettors lose money in the long term.
So the World Cup serves as a globally televised onboarding mechanism. The app a fan downloads to bet on a match in Mexico City is meticulously designed with vibrant colors and frictionless navigation to cross-promote digital slot machine and algorithmic table games.
The interface is built to seamlessly slide the user from a sports knowledge wager where they feel they have an edge based on their soccer expertise into a pure probability casino environment where the house advantage is absolute and mathematically guaranteed.
Here's where it gets really interesting, though. We're seeing a fascinating regulatory contradiction happening simultaneously. While mass-market sports betting is expanding globally and being cheered on by state governments collecting tax revenue, a federal regulator, the Commodity Futures Trading Commission, is actively moving to clamp down on online prediction markets.
Right. These are the text-based platforms that allow users to bet on geopolitical events, election outcomes, or foreign conflicts. The CFTC argues that allowing financial speculation on war or political instability creates perverse incentives that could lead to illegal conduct and degrade the integrity of the broader commodities market.
But how does the market justify regulating high-information geopolitical prediction markets into oblivion, while actively facilitating mass-market sports casino funnels with bright flashing lights that demonstrably strip wealth from consumers?
The economic reality is entirely structural. Sports betting platforms operate within a well-funded, highly lobbied corporate framework that generates substantial, highly visible direct tax revenue for individual states. Prediction markets, by contrast, are often decentralized, difficult to tax efficiently, and inherently politically controversial.
So the market logic dictating what gets banned and what gets a primetime commercial slot
Right.
is rarely about pure consumer protection. It's about which activities have been successfully institutionalized to generate taxable corporate profit.
Exactly. It's about who has successfully integrated themselves into the state revenue machinery.
We have been talking about companies building sophisticated traps to capture everyday consumers and their wallets. Let us pivot to how a corporate giant builds a strategic trap to capture an entire multi-billion-dollar premium brand outright. The British retail conglomerate Frasers Group, founded by the historically aggressive businessman Mike Ashley, has just made a formal, legally binding bid of £1.73 billion to acquire the entirety of the highly profitable German luxury fashion brand Hugo Boss.
The mechanics of this takeover attempt offer a textbook example of a creeping acquisition. Fraser's Group did not simply wake up this morning and launch a nearly £2 billion blind bid out of nowhere. They have been methodically and quietly building their stake in Hugo Boss since 2020.
Think of it like a game of Monopoly, where a player slowly buys up all the minor properties surrounding Boardwalk, tightening their grip on that side of the board until they can force the owner to sell the hotel itself. Frasers slowly accumulated shares over years until they owned just over 25% of the German company.
And under European corporate governance, specifically German financial law in this instance, once a shareholder crosses the 30% ownership threshold, they are legally mandated to make a formal takeover offer for the entire company. Frasers positioned themselves right at that regulatory trigger point to launch this massive acquisition.
Looking at the corporate strategy behind this move raises a significant probing question regarding long-term capital allocation. Frasers built its massive empire by swooping in to purchase distressed, bankrupt, or dying retail brands for pennies on the dollar. We saw this exact playbook during their incredibly messy, highly public battle over the dying Debenhams department store brand.
Were they engaged in a brutal bidding war with the online retailer Boohoo? Yeah. It was a strategy entirely focused on scavenging value from legacy names.
Why is a holding company famous for buying failing low-margin department stores suddenly paying a massive premium valuation, roughly €38 a share, for a healthy, highly profitable luxury retailer? Does this signal a fundamental shift in their core market strategy, or is this just classic ego-driven billionaire empire building?
This actually signals a highly calculated evolution in how retail conglomerates perceive brand equity in an era of persistent inflation. Acquiring distressed assets like Debenhams allows a holding company to extract whatever residual value remains in the legacy brand name, usually by slashing operational costs, firing staff, and aggressively liquidating inventory. It is a messy, short-term play.
However, acquiring a highly profitable luxury mark like Hugo Boss provides immediate turnkey access to a premium consumer demographic that is uniquely resistant to macroeconomic pressures like inflation.
Frasers is attempting to rapidly diversify its corporate portfolio away from budget-conscious shoppers who stop spending during a recession and secure a permanent foothold in the high-margin luxury sector.
The significant premium they are willing to pay reflects the stark reality of the fashion industry. Building a globally recognized luxury brand from scratch takes decades of marketing and cultural positioning, while acquiring an established one, even at nearly £2 billion, is an immediate, frictionless shortcut to premium margins.
It's the corporate equivalent of buying the fast pass at an amusement park. You pay heavily upfront to bypass the decades of brand-building friction.
Looking across these four developments today, a distinct pattern emerges regarding how modern markets operate behind the scenes. Whether we are analyzing a healthcare algorithm dictating an elderly patient's physical recovery, a budget airline monetizing the sheer panic of a parent trying to sit next to their child, a global sporting event functioning as a massive casino acquisition tool, or a retail conglomerate slowly tightening its financial grip on a luxury brand over 4 years. They all showcase distinct, highly engineered pressures to capture consumer margins and consolidate corporate power.
It really highlights an important reality about the market's increasing reliance on behavioral economics. Capital flows and corporate profits are no longer just dictated by traditional supply and demand curves. They are explicitly dictated by predicting human exhaustion and mapping our emotional vulnerabilities.
An insurer banks on a patient's sheer administrative fatigue to appeal a valid medical claim. An airline relies on a parent's sunk cost fallacy and willingness to pay a dripped fee rather than risk separation from a toddler.
And a sportsbook depends entirely on a patriotic fan's susceptibility to seamlessly cross-promoted casino games. The most lucrative financial models operating today are explicitly designed to tax natural human behaviors.
Which leaves you with an interesting audit to perform in your own daily transactions. As you navigate the next 24 hours, look closely at the moments where you are asked to pay just a little bit more for baseline convenience, for peace of mind, or simply to make a frustrating digital process go away. What other invisible fees are you paying today, and how much of your daily spending is actually just a toll collected by companies manufacturing friction solely for the purpose of charging you to bypass it? Thank you for joining us today for this exploration of the market's underlying machinery. We'll catch you next time.